Alibaba versus Amazon. Which stock is the better buy? Hello, everybody. This is StockerFinance. I'm your host, David Scheuer. Make sure to follow me on Twitter at StockerFinance for more information. Now, Alibaba's stock has been on a tear recently, up over 16% this past month to $251 a share, with a market cap of around $630 billion, a little more than that actually, and a PE ratio of just 31.45 with no dividend. Now, Amazon stock has also been on a tear, up to over 10% this month, has a market cap of 1.58 trillion US dollars, however, and a PE ratio of 151.17, so much higher than Baba, and its share price reflects that at $3,164 a share, but it also does not offer a dividend. So there's no easy answer to which stock is the better buy. I can't simply say, oh, it's Amazon, or oh, it's Alibaba. In my opinion, we can compare a bunch of different things and come up with some answers for which might be the better buy. We have to look at growth potential, we have to look at the fundamentals and the balance sheets. We're going to assess the risk, how much risk is on each stock. We're going to weigh that, as well as the market growth, where the markets at the in. How are they growing? Are they slowing down, etc.? So the first thing I'm going to go ahead and is look at the balance sheet, some of the fundamentals here. Now, I do want to point out one thing here. You see that I have it highlighted in red, the most recent quarter, and this is Amazon's chart here. The reason I have that highlighted in red is because Alibaba has not reported its earnings yet. Its earnings are in 10 days, so I'm going to be live streaming that on this channel. Should be super interesting, but I don't want people to get confused between that earnings and Alibaba's newest earnings. So in reality, when you see this latest one, this Q4 for Alibaba, you should be comparing it to Q1 2020 for Amazon. Now, Alibaba's recent earnings, when they come, it's going to be really interesting to compare, since Amazon pretty much crushed its most recent earnings, as you'll see on the charts here. But I just don't want you to make those comparisons and get these graphs confused, because it is a little confusing with that going on. So if we do look at revenue, not operating income, before we get too far ahead of ourselves here, we're going to look at Baba first. Baba has on steady growth across the board, and the same with Amazon. Both have steady growth across the board. Baba definitely took a hit this last quarter. It just really, the manufacturing got overwhelmed, and the manufacturing got shut down due to the pandemic, etc. A bunch of other stuff happened. So it's just, they got hurt pretty badly, but I don't think it's anything to worry about in the long term. Amazon has been on a tear as well. Had a slight slump, as you could tell, in Q1 as well from Q4, but it's still growing. If you look at the Q1 a year ago, it's significantly higher than that. Much steadier and stronger growth from Amazon. And if we look at Alibaba, it's a similar situation as well. So let's move on to net income. Net income is when it gets really interesting. Now, this is Amazon's net income. If you look at its most recent quarter, it crushed it, over $5 billion US dollars. And then its last quarter did pretty good as well, just about $2.5 billion in net income. And in Q4 2019, did over $3 billion. Alibaba's chart is much more interesting. Now, it's much more interesting because it's just kind of unique. It has steady growth, and it's a little more volatile, though. But one thing you're going to notice is the most recent quarter, Q4, and we can compare that to Amazon's at Q1 2020. Well, Alibaba got pretty destroyed. And again, that has to do with its margins just got crushed that quarter due to its manufacturing being shut down. That's the largest thing that really happened there. And if you look at its last quarter, though, before that, it got up to, in Q2 2020, it was up to $10 billion in net income. In Q3 2020, it was up to over $7 billion. Over $7 billion in net income. That's incredible. If we look at Amazon's, Q1 or Q4 2019, Q3 2019, it barely broke $3 billion. So for Alibaba to be just crushing that, it tells that it has the potential to make a lot of money, but it just needs to capitalize that. It needs things to work out well for it, which recently it really hasn't been working out well for, at least in Q4 2020. But the most recent quarter, we're going to see whether it holds up with Amazon or if it's going to fall further, stay the same or fall a little behind Amazon, as Amazon just keeps on tearing with more growth. So let's look at the margins, though. And this is one thing that really is interesting about these two companies. Amazon's margins are horrible, to say the least. Their margins are around 5%. That's where their profit margin's at. Operating margin around the same, and their gross margin up around 40%. But if we look at Baba's margins, well, its margins tend to be about 20 to 30%. It was as high as 60% at one point. The most recent quarter, again, they got destroyed because their manufacturing was shut down. They had a bunch of issues going on due to the pandemic. Remember, the pandemic hit China first, so they really felt the wave before it ever really hit Amazon. So because of that, Alibaba got hit kind of a quarter behind Amazon. This whole thing has really benefited Amazon in the long run. I think it'll benefit Baba as well. The thing is, Baba relies a lot on its manufacturing, direct manufacturing there in China. So when that gets shut down, it can't sell as many products. Whereas Amazon, it's has a different situation. It hurt it a little bit more, and it had some hiccups going on in the quarter that we saw. But because there's so many different U.S. companies selling on Amazon as well, didn't have to worry about that. Whereas Alibaba was really just selling directly from the manufacturer online. So it got hurt by those manufacturers getting shut down. That's why its margins plummeted. But we're going to see if it recovers in this coming quarter or not, and it'll really be the telltale of whether Baba can sustain and keep competing at the same level as Amazon and actually outperform them as they were doing before. Now, if we look at the operating expenses, steady growth in operating expenses as both these companies continue to grow. Nothing really too interesting to look at there, or nothing too worrying to look at, I should say. Look at growth for Amazon. Amazon has steady growth across the board, about 30-40% growth. We look at Baba, about the same story up until recently when growth slowed a little bit, just to like 20%. And again, that just has to do with the manufacturing getting shut down, factories. Just the whole area in China was going pretty crazy. Had the Hong Kong unrest still going on. So there's been some troubles in China going on that have really set Baba a little bit behind. I don't even want to say a little bit behind, but I've just kind of slowed things down. And in my opinion, it's just kind of a small roadblock that they're just having to, move out of the way. And then they're going to keep tearing through and go back to how they were doing before. But this upcoming quarter, again, will tell whether that's true or not. We're going to find out. If we look at cash and short-term investments, they both actually had about the same, 50 billion, and Amazon was about 50 billion to 40 billion as well. So at the same in cash and short-term investments. However, the most recent quarter for Amazon, its cash and short-term investments skyrocketed to over 70 billion US dollars in cash and short-term investments. That's incredible. That's a lot of cash and investments. Now, if we look at Baba, its most recent quarter, it hasn't been released yet. So it's going to be really interesting to see if they, since their cash was so similar before, if they are on the same level as Amazon this quarter as well. Now, I have a feeling it won't be. I have a feeling its cash will be a little lower simply because it had to sustain itself while it's manufacturing was kind of temporarily closed there. A lot of things were going on. I think I had to pump some money into those. But if it didn't, then its cash could be extremely high since its operating expenses also lowered during that time, just like Amazon. So now let's just do a little summary here on the Motley Fool. I think it's really summarized some comparisons between Amazon and Alibaba, their strengths and weaknesses. So if we look at Alibaba's revenue rose 35% in fiscal 2020, which ended on March 31st. Remember that Alibaba's calendar, their quarter calendar, is very different from Amazon's. And its adjusted EPS grew 38%. It expects its revenue to rise at least 28% in fiscal 2021. Even after bearing the impact of COVID-19, and analysts expect its adjusted earnings to grow 13%. Those are not robust growths for a stock that trades at 29 times forward earnings, but Alibaba faces several long-term challenges. It's increasingly dependent on its lower margin commerce business, JD.com, and Pinduoduo, sorry, I definitely pronounced that wrong, remain fierce rivals on Chinese e-commerce market, and Tencent remains a persistent threat in the cloud, digital media, and fintech markets. A new U.S. Senate bill, which hasn't been passed into law yet, could also force Alibaba and their other Chinese companies to delist their stocks, which is a big worry of mine, especially with what's going on with TikTok. Now, TikTok to me makes more sense for it to get banned from the U.S. with data stealing, etc. Alibaba, on the other hand, it's largely just selling, business to business. I don't think there's a lot of Americans that go and just shop on AliExpress. It's largely selling to people who then sell those products on Amazon or on other companies, or put their label on something and sell it in their store. So it's a lot of business to business to the United States that I actually think largely benefits the United States, except for some of the maybe some of the counterfeit stuff, etc. But I think it largely benefits the United States, and I'll be surprised if Alibaba does get their company delisted on the exchange. I think investors won't be happy about that, but if it does, it's definitely gonna hurt the company quite a bit there, since there's a lot of money in the U.S., especially from U.S. investors. Now, if we look at Amazon's strengths and weaknesses, Amazon's revenue earnings rose 20%, so less than Alibaba, and 14%, respectively, in 2019. In the first quarter of 2020, its revenue rose 26% annually, but its earnings tumbled 29% as it incurred roughly $600 million in COVID-19 related expenses. Amazon expected those expenses to rise and exceed $4 billion in the second quarter, which will likely offset its projected sales growth of 18% to 20% and result in a net loss. So Alibaba, that's the difference here. I think, Alibaba, its manufacturing got shut down. Its margins were already really high, but it kind of slowed down there. Wasn't able to, sell as much things, wasn't able to get going, but its expenses also decreased a little bit. Let me just double check that really quickly here. So as you can see right there, from Q3 2020 decreased a little bit. It increased a little bit from the previous quarter, but didn't see a massive increase. where with Amazon here, we saw an increase from even the previous quarter and the last quarter. So not a big surprise there, but we'll see what happens in the most recent quarter with Alibaba once it releases its earnings. Now, if we look at I'm going to keep reading this and going on here. Amazon expects it to rise. As I said, for the full year, analysts expect Amazon's revenue to rise 24% and for its earnings to tumble 18%. Those are unimpressive growth rates for a stock that trades at nearly 140 times forward earnings. Investors are likely to be paying a premium for Amazon because they consider it a COVID-19 headwinds to be temporary, but they could be overlooking three significant challenges. This is the thing. Amazon is a great company. It's growing respectively. It does have some problems going on as stated here, but it is growing as we saw from the growth chart as we're looking at its revenue, etc. Even its cash reserves and its short-term investments have grown substantially during this time. But its issue is that it's just such an expensive stock, 141 times its earnings. Some people might argue that is not expensive for Amazon because it's such a desired stock. But I mean, $3,000 a share, and just looking at its PE ratio and then comparing that to Alibaba's, where Alibaba, it's been more profitable. Its margins are significantly higher than Amazon's. It has some short-term troubles, in my opinion, that's going to have to get through. We're going to see in this most recent quarter coming up here if it can get through those quarters or how it's going to get through them. But just the margins make the huge difference here. And then what the companies are currently trading at is such a huge difference, especially when Alibaba, had the same amount of cash, its margins are higher. And if we're going to look at a second here, the market is growing quicker as well. It's, I think the only reason its PE ratio is so much lower is because the risk of its company getting delisted from the U.S. Stock exchanges, which could be, it's very negative for Alibaba, and that's going to keep a lot of U.S. investors really wary and kind of aware of I think keep away from Alibaba. It also doesn't have, it's not on the S&P 500. It can't be on these American indexes, which causes it to lose a lot of that big investor money from a lot of these big, endowment funds, pension funds, etc. So that's some of the differences to explain it there. If we look at the differences between Amazon and Alibaba, which I'm going to continue on with this article. Sorry, I know this is a little long, but Alibaba is often referred to as the Amazon of China, but that nickname glosses over the two companies' fundamental differences. Alibaba generates most of its revenue from its core commerce business, which includes its online marketplaces and brick-and-mortar stores. The rest of its revenue comes from cloud, digital media, and innovation initiatives businesses. Alibaba's core business is its only profitable segment. Those profits subsidize the expansion of unprofitable businesses, which broaden its ecosystem and widen its moat against rivals like Tencent and Baidu. Amazon also generates most of its revenue from its online marketplaces, but most of its profits come from its market-leading cloud platform, Amazon Web Services, AWS. AWS accounted for nearly a third of all cloud infrastructure spending worldwide at the end of 2019, which is pretty incredible, according to Canalys. The superior scale enables AWS to operate at a much higher margins than Alibaba Cloud, which remains a much smaller player in the global cloud market. I think Alibaba is about like fourth in the cloud market right now, or fifth. Therefore, Amazon subsidizes the growth of its lower margin e-commerce businesses or marketplaces with its higher margin cloud revenue. This strategy gives Amazon more room to consistently expand its ecosystem with Prime memberships, digital content, and brick-and-mortar stores. So if we look at the next thing here, and I just think that was a really great summary for some of the differences in how these companies operate, their most recent, or some of the earnings in the past, the growth, etc., different things going on. I just think that article summarized it well. If we look at the populations now and the markets they're in. So the markets they're in largely have to do in terms of just their, e-commerce sales, which how big the population is and the spending power, etc. Now let's look at this chart here. You have all the different continents here. Look at North America. Its growth rate is 0.62%, pretty slow. And it has a population of 368 billion. Europe, 700 million. Europe, 700 million, growth rate of 0.06. So the slowest on this entire, out of the whole world, Europe is growing the slowest. It's only 9.59% of the world's population. North America, 4.73%. Now, let's look at Asia. 4.6 billion people. Nearly 60% of the world's population with a growth rate of 0.86%, so the third fastest growth rate on this chart, which is pretty incredible. Now, Asia's huge in terms of just the land mass, so I think if we go to this next chart, it might help to summarize it a little more. If we look at just South Central Asia and just Southern Asia, and I guess Eastern Asia as well, we'll probably leave out some of the more the Western Asia areas, because I think Western Asia is more like India. I know India and some of those countries are having issues with China right now. There's some tension going on, so I'm going to leave them out. I'm not sure about Alibaba's operations in those countries as of right now. But if we just look at South Central Asia, Southern Asia, and Eastern Asia, well, that's over, what is that? 2, 3, over 4, I'd say that's what, 6 billion people. That's incredible. I mean, just South Central alone is 25% of the world's population, more than Europe and North America combined, and it's growing at 1.16% and 1.17% respectively. So growing incredibly fast. Eastern Asia at 1.67%, 21% of the world's population with a 0.33% growth rate. So it's just the number of people is insane. And you might be arguing, well, that doesn't matter. There's tons of people. They have no spending power. Europe and America is just so rich. Not necessarily. These are developing. I don't want to call them developing countries because they're really, a lot of them are already incredibly developed now, at least parts of the country. And the people are, in China, more and more people are going into the middle class, upper middle class as the country becomes richer and richer. And so they're having more spending power. They're buying more cars. Why do you think, Tesla is doing so well in Asia? If China was a poor country, none of them would be buying Teslas. This is expensive luxury vehicles. But instead, Tesla has so much demand, it can't even keep up with it. And because of that, you can just tell that Asia, and especially that section of Asia, since Asia is just such a large continent, it's growing as a huge amount of the world's population. And down the road, let's say 10 years from now, when their spending power is going to be incredibly powerful, there's going to be even more people. Alibaba is going to be in a great place since it's already the dominant player in e-commerce in that area, especially with its high margins. So Baba seems like maybe a better buy. And that's a controversial statement, I know, but if ER is good, so if its earnings reports come out and it's the same as Amazon or better than Amazon's, show that they're growing, they have the same amount of cash or more cash on hand than Amazon, they're incredibly profitable, they recovered from whatever, the slump that they were facing, their margins are back to normal, their net income's back to above that of Amazon's, then it really seems like a no-brainer buy, and it seems pretty undervalued. As it has higher margins, it's making more money than Amazon, it's faster growing market, and that's making more money is a hypothetical statement if its ER is good and if it shows out. So it's an unprofitable segments are sort of en route to profitability. I said en route, it's kind of a bold statement there. Business to business model is still growing, most likely with the release of an AWS type service with its cloud, growing so much. I wouldn't be surprised if it releases some sort of service or its cloud growth just continues to grow as more companies throughout Asia need that type of service, and better revenue growth as well. However, there's risks with Alibaba. Now, as I've talked about, China versus United States trade war, Alibaba could get delisted from the United States Stock Exchange. That's a huge risk that is becoming more and more realistic every day. I don't think it's going to happen, personally. I think Alibaba, the way it operates in the U.S., is not necessarily a threat to United States companies as much as, or people as much as TikTok is. Alibaba does a lot of business to business e-commerce there, whereas wholesale stuff, whereas TikTok is stealing data, have the ability to get a lot of private information from individuals and Americans. Baba's kind of on a different playing field in a different section of of work in the United States, in my opinion. You can argue with me all you want. I'd love to hear you guys' opinions on that matter. Now, there's also India versus China tensions, as I had talked about. So a lot of this just has to be with China's political tensions throughout the world that hurt Chinese companies. And the main thing, even if it doesn't hurt their sales or profitability or their bottom line, what it does hurt is investors wanting to invest in them as a company. Its PE ratio is 30. Amazon is 151. Why is that? Because investors just don't want to invest in Alibaba. It's not as a desired stock as Amazon is. It's not on the American stock exchanges or indexes, not stock exchanges. Sorry, misspoke there. And it has some competition, Baidu-intense competition. I don't think those are the biggest deal to Baba, though. Pandemic scares, manufacturing really just got shut down all of a sudden throughout China, which definitely hurt Alibaba significantly, etc. So there are risks with Alibaba, and I think a lot of those risks are keeping its price down, and definitely compared to Amazon's price. However, all depends on Alibaba's upcoming earnings. I think I'm going to do a pre-earnings report. I'm also going to be live streaming it on this channel 8/13. So subscribe and turn on notifications for that. Now, Amazon, in my opinion, is a safer. It's a growth stock, has pretty solid fundamentals and tight margins. Its PE ratio is 151.17 though, and it's over $3,000 a share now. Alibaba is a little riskier with some of the tensions going on in the world, but it has faster growth potential. It's a growing market and has really large margins with a PE ratio only 31.45 and only $251 a share. Actually, a little higher today as of Monday. Thanks for watching. Please subscribe. I know this video went out a little long, but make sure to check out these videos as well. New videos coming Wednesday, Friday, Monday, Wednesday, Friday, every week. Follow me on Twitter @StockerFinance, and I'll see you guys in the next video. Peace out.